Hello, class. We are at the very last chapter of Intermediate Accounting. I know from Intermediate 1 to Intermediate 2 here at the University of North Texas, we use one big monster book. I should have brought it. We are at the last chapter, and we have now at UNT covered all the materials in that chapter. Obviously, almost all of this is tested on the CPA exam, hardcore, and very important. And our CPA rates are increasing here, and it's because of the diligence of our chair and the professors who are really just totally dedicated here. Obviously, we are in the middle of the coronavirus, and everything's going online. That's why I'm doing these videos now. And it's a very weird day because it's St. Patrick's Day. And I worked in New York City where, boy, the St. Patrick's Day parade, a rite of passage, and spring is beginning, and it's just so much fun. I had a lot of great fun watching the St. Patrick's Day parade when I worked in public accounting in New York City. But here it is, St. Patrick's Day here at UNT. I've got the green, and that's appropriate because it's the home of the mean green here at UNT. But no parties, all the bars are closed. Not that I could partake because I gave up wine and beer and all alcohol for Lent. So it wasn't going to be a drinking St. Patrick's Day for me, but it would have been a fun day. But here I am, St. Patrick's Day, celebrating with you for video. So whenever you're watching this video, I know it will not be St. Patrick's Day, but I hope that you're safe and that you're doing well as we approach the very end of this course if you're in my class and watching this video. So, and you better be watching it if you're in my class. So, and many of you who've taken my classes before, Principles of Accounting, you know how much I love the cash flow statement. And I will never invest in a company, buy a stock, if I have not looked at the cash flow statement. There's a lot of information available on that cash flow statement that you don't see from the income statement. And because of accrual-based accounting, we have a lot of non-cash expenses and other things that are happening in the business that might not tell the whole story. Still important. I would never discount the income statement or the balance sheet because I want to know how much debt's out there. I want to understand the leverage of the company. But in the cash flow statement, I get another feel, right? And it's important to me. And I like investing in companies that pay dividends. And so on the cash flow statement, in the financing section, you can see amount paid for dividends. And I can compare that to what? Cash flow from operations. Are they generating enough cash to pay those dividends that matter to me? Because dividends are optional. Obviously, I'm going to look at the income statement. Is this company making money? Do they have good gross profit margins? But it all comes together for me in the cash flow statement. So I have a lot of energy for chapter 21. And if we were not doing an online exam, you would be doing a full cash flow statement in class as a part of this exam. And we will practice those. I'm going to create multiple choice questions that will make you have to do a cash flow statement. And so don't worry, I will make sure you understand this. And so there are a lot of things that the cash flow statement helps us with in understanding the future, right? Because if we're generating cash, we will know that we have a good source of cash from operations, but also where's the company using that cash? Are they investing in their business in capital expenditures? Don't see that on the income statement. We see it on the cash flow statement, and that's going to be in the investing section. A company that has really high profits, making a lot of money, but I don't see a lot of capital expenditures, investment in assets. Is that sustainable? So I see a company making money, but also investing in new assets, in new locations maybe, and new software, whatever. Then I know, hey, this company is not just doing well currently, but they're investing for the future. And so that's why this slide says projection of company's future profitabilities. Where are they getting their money from? Is it financed with debt, equity? Are they acquiring facilities? How much does cash generate from operations compare with net income? That may be a take. If there's a big disconnect between cash flow from operations and net income, are there some accounting errors lurking in that net income? So that's not a high quality income statement because it's hard to hide the cash on the cash flow statement. And then what happens to cash is how is debt being retired. In a lot of cash flow statements you see these days, a lot of new debt. Companies are borrowing money. And what are they doing with it? They're buying back their shares. And by the way, I can see cash paid for repurchasing shares right there in cash flow from financing. So there's a lot of information sitting in a cash flow statement that if you're going to invest in a company, you want to know it. You need to know it. So here, now we're going to be in the point of view of accountants preparing that cash flow statement, knowing other people are going to rely on this. It's very crucial that we get this right. And so we have three types of cash inflows and outflows. Operating activities, so cash, this is in cash flows from selling stuff and cash paid for expenses. A lot of accruals in there. Think about depreciation expense, non-cash expense. That's going to be here. So that will be, that's going to be an add back, if you will, to net income. And almost all companies have some level of depreciation expense. And investing activities, inflows, sell of property, sell of investments, or more, purchase of property, plant, and equipment. That's what I call capital expenditures, purchases of property, plant, equipment, and intangible assets. We call that capital expenditure. That's a very big point here. In fact, at Lennox, that's something that we had to disclose in our investment call every quarter with analysts, Wall Street analysts, as public information, how much we anticipated capital expenditures should be for the year. And so if it's too little, that's not good. If it's too much, they wouldn't want to, what are you buying, how are you using that money? So a lot of conversation around capital expenditures in that shows up on the cash flow statement. And then finally, financing activities, what's the source of our funds? Are we issuing stock or bonds? Are we paying dividends? Are we repurchasing stock? So there's a lot of information about long-term debt and equity cash here. And so that's also very important. So here's an example of a statement of cash flows. This is what we call, we'll get into it later, called the direct method. There's a direct method and an indirect method of calculating the cash flow statements. And it only relates to cash flow from operations. And so here's inflows, directly what we receive from customers, and line items of who we paid cash out to get to cash flow from operating. That's what we call the direct method. Then here we see purchase of land, purchase of investments, sale of land. That was an inflow of cash, a positive number. Here is a cash received. So we sold land, we received $18 million in land. We sold equipment, we received $5 million. But it was a cash outflow, a negative number for investing activities. And here's all the things that happened in financing. We sold some shares, we retired some bonds, we paid dividends, cash flow from financing. If you think about this for a minute, we want cash flow from operations to be large. We want to be generating cash from running our business. We want this number to be negative. We want to see companies investing in the future, generating a lot of cash, but also investing that cash in things, in investing activities, land, or purchases of other companies, other investments, equity method investments. That all goes here. We want that to be a negative number because we want to see the company investing. Now here is, okay, if that number is insufficient, where did they get their money from? Here, this was sufficient covering, but we still end up with a cash inflow, positive cash inflow from financing, mostly, it looks like here, from sale of common shares. So we issued some new shares in this year. This is what we call the indirect method only for cash flow from operations, not for financing or investing. And we start with net income and we make adjustments for non-cash items in net income and changes in current assets and current liabilities. And we're gonna spend more time on the indirect method in this class than we are on the direct method. One thing we have to think about when we think about cash flows, what is cash? Because we have a lot of short-term investments, maybe overnight funds, or treasuries, things that will be liquid in 1 or 2 months. And so every company needs an accounting policy on what they're going to call cash. And for my company, I believe it was 3 months. Anything that could be readily turned into cash within 3 months, we called that cash. And so a lot of times we call it cash and cash equivalents. Restricted cash is a little bit different animal because that's cash set aside that's restricted from the company using it. It might be set aside to pay bond interest or other things, and so that's a different. But this is going to be disclosed for every company. What do we call cash and cash equivalents? And so here, if we bought a treasury bill with cash, credit cash, debit a treasury bill, if that is something we consider a cash equivalent, that is no impact on the cash flow statement because it's just a move between different types of cash and cash equivalent. And so that's why this matters a lot. And so mere transfers of cash to cash equivalents, really you don't have to report. So that's just movement inside different cash accounts. Why you don't report? Nobody cares. Nobody cares about that. And so the primary elements of the cash flow statement: operating, investing, and financing, which we've talked about. However, we got these other two pieces. One is the non-cash investing and financing. So we might invest in an asset, but we don't pay cash for it. We borrow it. So we have an investing activity and a financing activity, but no cash. And if cash doesn't change hands, it doesn't show up in operating, investing, or financing. But we have to disclose it there, so it's material. Hey, the company bought a $100 million property and borrowed and signed a notes payable or mortgage for that property. That would be a disclosure item on the face of the footnote right there with the cash flow statement, but it would not be one of these three numbers. And then finally, we're going to reconcile the beginning cash, beginning of the year, cash from operating, investing, and financing, and ending cash to make sure that rolls from beginning. That all that will be disclosed on the cash flow statement. That's a relatively easy one, and we'll work problems around that. So here's the direct method. Let me just stop here and talk about the direct versus the indirect method, because boy, throughout my career, especially in my 15 years as chief accounting officer of those two companies, and I was reading all the FASB speeches, the SEC, they give annual speeches, usually in December. I was reading all these speeches, and every single one of them, for 15 years, are saying, we want you to use the direct method. And even in the rules, the FASB said the direct method is strongly encouraged and recommended. Don't use the indirect method, use the direct method. And I heard SEC speakers say it, I heard representatives from the FASB say it in speeches. I read their speeches, I attended some of them, and guess what? Total rebellion. No company that I know of uses the direct method right off the bat. It's like, because I'd have to go create all new systems to try to do a direct method. So in this class, I'm going to highly focus on the indirect method, not the direct method, but there may be a couple of multiple choice on the direct method. It's a direct method, again, I'm going to get cash flow and cash outflows from direct things that happen in the business. That means I got to set up almost new systems to capture that, one thing that makes it hard. And so cash inflows from customers, revenues, here's an example of the direct method here, and you can look at that. Again, direct versus indirect, we're only talking about operating activities. No changes to financing or investing. And that's relevant. That could be a good exam question right there. Then here's the indirect method. We start with net income. And so I can do an indirect method. You give me an income statement and a balance sheet, I can do an indirect method right away. And that's what we'll do. We'll work 5 different cash flow statements as our problems for this chapter. And so if you work those with me, even though you're sitting at home, you work them as I work the problems, you're going to know how to do a cash flow statement. And I've had students come back to see me, and they went to work in internships. They said, man, Roy, the first thing they asked me to do was to go do the cash flow statement for these 5 companies. I said, man, I knew it. I knocked it out, and I was a star. So this is one you could be asked to do. And I think I think it would be fair for public accounting firms to expect you to know how to do it. And so don't think this is something that's a waste of your time. This matters, you can do it. And so here's the indirect method. I start with net income. I add back all the non-cash things, depreciation and expense. We'll get into gain and losses. That's a little bit of a nuance here we'll talk about. And then we do the changes in the current assets and the current liabilities, and we get down to what's cash flow from operations. So these are all operating items on the balance sheet. So if receivables increased, then we receive less cash from collections, right? It works in decrease in inventory. Well, we use some inventory that we bought last year. So you can get to the same answer. By the way, indirect and direct, you should get to exactly the same answer. In fact, the funny part is, if you do the direct method, you're also required to do the indirect method to prove that you got it right. And so I said, well, why? I'll just do the indirect method. Not that I'm lazy, but it'd be wreak so much havoc on the business to change all your systems to do it. So another reason that a lot of companies use the indirect method. All right. So investing activities, both the acquisition and the disposition, that means the sale of assets, gets recorded here. So property, plant, and equipment, investment in securities, but guess what? Not trading securities. Why? Why would trading securities be excluded here from cash flow from investing? I wish you were here to answer that. Trading securities, by definition, that's a business that is trading securities every day as part of their operations. So banks, they're buying securities, they're holding them for days, minutes, sometimes hours. They're constantly trading securities. That's their business. So when we have trading securities, not in investing, in operating cash flows. So keep that in mind. Their current assets in operating cash flows, because that is the business that they're in. And if they have trading securities. Held to maturity securities, they're going to be in the investment side, investment in securities, because they're held to maturity. They're long-term assets. We're investing with a purpose. It's not part of our core business, buying and trading. And so when any of these assets are sold, any cash receipts will go into investing. So here's an example of investing, purchase land. This is more like the direct method, right? And there's no indirect method for investing. This is just how it works. All right, financing. Now we're getting into two areas of the balance sheet, long-term debt and equity transactions. These are going to relate to financing. What is our source of our funds to run our business or to grow our business? So here we go. Sell our common stock or preferred stock, that'd be cash inflow. Obviously, repurchasing would be a cash outflow, buyback of stock. Issuance of bonds or other debts, so we issue bonds payable, we receive cash, right? Go back to chapter 14, and that would be in the cash flow from financing. Then we can also repay those bonds. So if we get to the end of the term and we pay back that face value, that's a negative outflow of cash. That's going to be on the cash flow from financing. And there you go, my favorite line item. I can see payment of cash dividends. And I can compare it to cash flow from operations to see, hey, does this company have problems? And so can they continue to pay their dividend? And I can give you a lot of investment stories where I could see that wasn't going to be possible. So here in this company, they sold 26 million of shares. They paid 15 million out on bonds that reduced their debt, and they paid $5 million of cash dividends from where? From retained earnings. So I can look at my balance sheet, and I can look at changes, and I can take those changes and put them on the cash flow statement, and that's what we're going to do. Here's the reconciliation. We started the increase in cash, and that increase in cash of 9, that came from adding cash flow from ops, cash flow from investing, and cash flow from financing together. That equaled 9. I started with 20 of cash, and I ended with 29. Therefore, that tells me I'm reconciled. The cash flow statement is accurate. I have accounted for every dollar change in cash between operating, investing, and financing. So every dollar change in cash is going to show up in the right buckets. And It's going to tell, if all you saw on the balance sheet, oh, we started with 20 and we ended with 29 in cash, there's no story to that. There's no story at all. The story is when you get into, hey, what happened? How much cash did we generate from our operations? It could be negative. You could have cash outflow from operations. Let's hope most of the time it's positive. And then how much did I invest in my business, cash flow from investing? And if I needed, what was my source of financing? If I had a bad year, maybe it was negative cash flow from ops. Where did the company, how is it going to sustain that? Where is it getting its source? And if I see issuing stock or issuing new bonds, that could let me know what's going to happen to the debt versus the equity comparison and ratios in the future. So a lot of information there. You can tell the whole story of a company many times by looking at that cash flow statement. Okay, this is the last item here. And so if we buy 20 million of new equipment by issuing a $20 million long-term note payable, so that's an investing activity, right? And this is a financing activity, but guess what? No cash. Therefore, no change in cash doesn't end up on the cash flow statement. But this is so significant, we need to disclose it. And so we'll have non-cash investing and financing activities, acquired 20 million of equipment by issuing a 12% 5-year note. So the whole story is out there because you can't skirt kind of the rules and do it this way, so you can see everything there. That's required disclosure for the cash flow statement. So we're going to do these. I don't have to spend a lot of time on this, but you can start with the income statement and the balance sheet. You'll need a little bit of additional information. And yes, definitely, we used a big electronic spreadsheet, a monster one, because we had to convert 25 currencies and hundreds of general ledgers, not only in the income statements, but in the cash flow statements. And that was a monster work, took a couple of days. And we got to kind of reconstruct everything so that we know was cash involved in this, the cash outflow or cash inflow for every transaction in the company. But by looking at a balance sheet and a few other pieces of information, we can get there. Now, in the direct method, because this could be certainly fair to be on an exam. If I'm using the direct method, how do I get cash flow from customers? Well, I can look at the change in accounts receivable. I know I had a beginning balance of 30. I had credit sales of 100, and I ended balance with 32. So I can calculate out, solve for X, right? This is certainly fair game. So if I was using a direct method, this is where I would find out how much cash I received from customers. In the indirect method, I would say I got a -2 from net income. So my net income included 100 million in revenues, but I didn't collect it all. So in the indirect method, I would have that -2. We'll see how that works in the indirect method. But this is mainly, how would I calculate cash received from customers for the direct method? Well, I can just look at my change in my accounts receivable. Here, how much did I pay to employees? So my salary expense was 13, but how much did I pay? I can go look at my salaries payable account because I started with 1, I debited expense for 13 and credited the payable for 13, but I ended with 3, so I'm solving for X on how much cash I paid to my employees, and so that answer is going to be 14 minus 3, 11. And so I can calculate that out. Again, for the direct method, I can go into each balance sheet account and figure out what my cash paid for each of my line items. And so, so it is a doable thing. In the indirect method, we start with net income and we work backwards from net income to calculate cash flow from operations. Again, only operations is affected by that. And so here's an example. We're going to get into these. I have a little summary sheet that will help you. Basically, let me say, number 1, we're going to add back non-cash things like depreciation expense, gain on sale of land, loss on sale of equipment. Well, that needs to be in the investing section, not in cash flow, so we got to pull that out because it's sitting in net income. And then I'm going to look at all my change in my current assets and current liabilities. If my current assets go up, that had to be a negative cash flow item. If my liabilities go up, it means I didn't pay for some stuff that I expensed in net income. That's going to be in the same direction, and we'll walk through that in the next lecture before we work problems. But I mean, here's amounts that are subtracted in terms of net income are added back. Amounts that are added are subtracted. So we're reversing these because we start with net income, and so if there's non-cash expenses in that net income, I got to add them back. If there are non-cash gains in net income or that relate to finance activities, I got to subtract that. Again, this is a good slide, not a bad slide, but it's easier to show you when we work problems together in the next slide. I'm going to skip by that one because we'll see it. I'm going to skip by that. And that's it. Cash flow, that's our lecture, our last lecture on PowerPoint slides. And in the next lecture on chapter 21, we're going to work 5 cash flow statements. So set some time aside to work those with me. And that's going to be really valuable for you. And I just strongly believe accounting takes practice, especially with the cash flow statement, and you'll see some of the logic play out, and I think it'll help you internalize some of these concepts here. At the same time, don't forget how important the cash flow statement is. The story that it tells investors is big, because all those changes in cash, how much are we generating from operations? How much are we investing? What's the source of our funds in financing? There's a lot of storylines there that I can look at a cash flow statement and I can understand the story of the business, not only what happened in the past, but predict the future to some degree. So that is my last PowerPoint lecture for intermediate accounting. Oh my God, it was good. Such a great year to start, and I miss you guys, I really do. And have a great summer.